seen a lot of videos on chart patterns on YouTube and how to trade them. But most of these videos don't tell you why you should trade them and in fact why these chart patterns actually work in the market. So this is going to be one of the most comprehensive courses on chart patterns out there. Many professional traders even sell paid courses on chart patterns that are worth thousands of rupees with very little content. But guess what? This course is completely free of cost and is exclusively for educational purposes only. So share it with all your fellow traders and friends. And if you are new to the channel, consider subscribing to the channel and also enable the bell icon so that you won't miss out on any upcoming videos. Now the working of these chart patterns are quite simple. Chart patterns work by representing the market's supply and demand. This causes a trend to move in a particular way on a trading chart, forming a particular pattern. So when a trader looks at the price chart of a stock or an index, it can often appear to be completely random price movements. This is often true, yet within those price movements are patterns. So chart patterns are geometric shapes found in the price data which can help a trader understand the price action as well as make predictions about where the price is likely to go. However, chart pattern movements are not guaranteed and simply trading the chart patterns is not a sure shot way to success in the markets, and it is better used alongside with other methods of market analysis. So in general, there are three types of chart patterns. There are continuation chart patterns, reversal chart patterns, and neutral chart patterns. The topic of discussion in this video are continuation chart patterns. I will talk about 5 most common continuation chart patterns and why and how they are formed and how to trade them with the proper entry, stop loss, and target setups. So if you don't know what continuation chart patterns are, as the name suggests, these patterns signal that the existing trend in the market will most probably continue, or in simple terms, it predicts that the market will continue in the same direction after the end of the pattern. Now, most of these continuation patterns are formed as consolidations in between trends. So it's like market taking a tea break because of exhaustion and getting back to work after refreshment. We will be discussing 5 patterns and their subcategories. We will start off our discussion with flag patterns, followed by pennants. Then we will talk about the ascending and descending triangles. Further, we will discuss about the rectangle patterns. And finally, we will wind up with cup and handle and inverted cup and handle patterns. Before moving on to the patterns, let me make something clear upfront. It's none other than time frames. All these patterns that I am going to talk about forms in almost all the time frames, from intraday to swing to positional time frames. All these patterns work better as the time frame increases because it takes more time to form and therefore more people are aware of them. Moreover, the time frame to trade these patterns will depend on your trading style, the duration you want to hold positions, and your expectations. So I have already made a video on how to select the appropriate time frames to trade. So you can watch that video to know which time frame to choose depending on your trading style. Okay then, let's get started. The bullish flag or the bull flag, as the name suggests, forms during a bullish trend. The bull flag starts with a strong, almost vertical bullish trending move, which then stabilizes and turns into a minor bearish correction with parallel tops and bottoms, which are important levels of supports and resistance. Now, there are 3 components to any flag patterns that make it. So I am going to give you a few hints to correctly identify the bull flag. We have to look for a preceding up move or an uptrend, which makes a flag pole. As we know that the bull flag pattern forms during a bullish trend. This means that the candle's range is more bullish than usual and they tend to close near the highs. So it is a strong indication of buying interest in the market, and it also signals that the bulls are dominating the market. Now after the strong move higher, the market needs to take a break. Now this can be seen as a profit booking phase where the initial buyers are looking to book some of their profits. So here's where you can expect a potential bull flag to form as the market does a pullback. Now the type of price action that is exhibited in the pullback is what separates a flag pattern from a normal pullback. Now what you are looking for is a shallow pullback that consists of small ranged candles compared to the earlier strong bullish move, or it can be seen as a group of indecision candles after a strong bullish move. Now this tells you that the sellers are struggling to bring the price down and that the buyers are still in control. Now if you see a steep pullback with large range of candles, then it's probably not a bull flag pattern. Generally, this retracement ends below the 38% threshold of the original trend as indicated by the Fibonacci. So in general, it may not be considered as a flag pattern if the retracement goes below 50% of the pole. Now the tighter this range, the more likely the market will break out higher. Now that we have learned how to identify a bull flag, we can discuss how to trade the flag pattern. So I will discuss the entry methods, where to place the stop loss and how to set the targets. Now starting off with the entry criteria, as it is a bullish continuation pattern, we are only interested in the break above the resistance line. So you can take a long entry following a breakout of the level. That is, you can enter at the moment when the price breaks above the resistance trend line, or you can look to buy above the high price of the breakout candle after it closes. Now the second method is to wait for a pullback or a retest back to the breakout level and then take a long entry when the price moves higher or when the price moves above the breakout candle high. Now you may be probably wondering which one is a better method. Well, there's no best approach. Let's say if you enter the trade as and when the breakout happens, it could potentially result in a false breakout also. But if it is a real breakout, it's the best possible price you can get. Alternatively, if you wait for a close above the highs, you will reduce your chances of a false breakout. But if the breakout is too strong, you will end up entering at a much higher price. The same is the case with waiting for a pullback or a retest, which may not happen often if the market is trending strongly. And as a matter of fact, you will miss out on the trade completely. So it is up to you to decide your entry strategy and continue practicing it over a large number of trades. And above all, it is always recommended to confirm the validity of a breakout using volumes and other indicators. So a higher than average volume can validate a breakout most of the time, as it shows the interest of the market participants. And low volume breakouts are most likely to fail. Using momentum indicators like MACD and RSI can also help you identify a true breakout. I have already made videos on all these topics, so if you want, you can check them out. Let us now focus on the criteria for setting stop losses. So how to set your stop loss when trading the bull flag pattern? Now you don't want to set your stop loss at obvious levels like supports and resistances, swing highs or lows, etc. And why is that? Because you can get your stop loss 100 easily. It is as obvious a level to you as it is for others, including the smart money. So how do you get a proper stop loss setup? It's simple. Your stop loss should be at a level that, if crossed, invalidates your trading setup. So what are we trading here? We are trading a bull flag, and the pattern becomes invalid when the price breaks and closes below the bottom trend line support. So you have to keep your stop loss below this particular support level. But there are still chances of long wicks which can take out your stop loss and then move higher in the desired direction, which can be pretty annoying. So to be extra safe, you can give your trades more breathing space by setting your stop loss a particular distance away from the market structure using an indicator like ATR. So once you identify the swing low of the bull flag pattern, set your stop loss 1 ATR below the swing low level. And now let's learn how to set target for bull flag patterns. Now there are many ways you can cash in your winners. And one of the most common approaches is to have a predetermined profit target based on the length of the flagpole. This method is also known as the price projection method. Let's measure the length of the flagpole from the bottom of the bullish price move to the top of the resistance level, and then project this length from the breakout point above the resistance trend line. And this will be your profit target in the future. An alternate method is to choose to trail your stop loss until the market takes you out of the trade. Why is this a better option? Think about this. The bull flag pattern usually appears in a strong trending market or just after it breaks out of a range. In such market conditions, there is a lot of potential for the trend to continue, and the only way to ride it is to trail your stop losses. Now the question is, how to trail your stop loss in the best possible manner. Well, you can use a tool like moving averages or Chandler's stop to trail your stop loss and only exit the trade if the market closes beyond it. Moreover, it is much better if you use a combination of both the projection method and the trailing stop loss method so that you can predict the future move beforehand using the price projection method so as to lock in part of your profits there and then ride the rest of the position using the trailing stop loss and thereby not impacting your psychology and avoiding any potential losses. Now moving on, in the market there are numerous opportunities that are available for trading bull flags. But if you were to ask me to select a few, I would choose 4 different scenarios to trade with a bull flag so that my risk to reward is satisfactory. Now these 4 scenarios includes number 1, the formation of bull flag during a level breakout which is followed by a primary pullback. The second scenario is when the flag formation occurs during an uptrending market which further signals a trend continuation. The third scenario is when bull flags occurs inside a range market, and the final case is when the bull flag occurs in a downtrend signaling a trend reversal. Now the entry, target and stop loss criteria are the same for all these cases, so I won't be discussing them individually for each case. Let us take a look at the first case. This happens when the market breaks out of a range and then does a pullback for the first time. This is one of the best times to trade the bull flag pattern. And why is that? Because when the market is in a range, it will eventually have to break out. And besides, the longer it stays in a range, the harder it will break. So what we are concerned about here is a resistance breakout where we can expect a bull flag to form. So when the market finally breaks out, the traders who missed the breakout move can wait to enter the market at the first indication of a pullback. These primary pullbacks usually have a shallow retracement as not many traders want to trade against the strong momentum. And this presents a pullback trade with a very high probability. So if I were to explain the process in a rather simple fashion, it would go something like this. First of all, you have to identify a range market or a market testing a resistance level for quite a while. Now let the market break out of the resistance level. Now you have to wait for a bull flag pattern to form in the form of a primary pullback. Now once you find such a formation, you can look to take a long entry on the break above the highs. Has it ever occurred to you that you think the price is too high and it would be better to wait for the price to retrace to the support or back to the breakout level before you go long? But the next thing you know, the market continues to break new highs and you are left on the sidelines regretting your decision. So have you learned something from this? To put it simply, in a strong trending market, it's far easier to buy breakouts than to wait for the price to pull back, which rarely occurs. In such a market, you can use the bull flag pattern as an entry trigger. Here's how you can trade bull flags in a trending market. Now the first step obviously is to find the market trend. You can look for strong trending market with the use of moving averages. For example, for short-term trades, you can make use of 20 symbol moving average, and for swing or positional trading purposes, you can make use of 50 or 200 period moving averages. Now, for this case, let us consider a 20 moving average. When the price trades above the 20 moving average predominantly and is sloping higher, we can conclude that the market trend is strongly bullish in a short-term scenario. Now you have to wait for a bull flag formation to develop in the form of a pullback. Now once you identify a pattern, you can look to take a long entry. Now as I have mentioned earlier, the same entry, stop loss and targets can be used for this purpose. Predominantly, you can expect a bull flag to form after a breakout or during a strong trend. However, there are times when a bull flag pattern can form when the market is in a range and at a resistance level. So in one of my price action videos, I have talked about the concept of breakouts with build up near a resistance or support level. You can find the video on the I button if you want to learn more about it afterwards. Now the same concept applies here. A build up near a resistance level happens because there are no sellers stepping in or the buyers are willing to buy at higher prices. Now whatever is the case, this is a sign of strength and the market could break out higher. So how do you identify such an opportunity? Primarily, you have to identify a market which is in range. Then you have to wait for a flag pattern to form near the resistance level in the form of a build up. Now as always, you can trade the break above the build up or wait for the market to close above the resistance level. There is no change in the entry, stop loss and target criteria for this case also. Now if you are probably thinking what the hell this dude is talking about. Just a few minutes ago you said that bull flag is a trend continuation pattern. Now why are we looking for it in a downtrend? Yes, there is no denying that the bull flag is indeed a trend continuation pattern. But what if I tell you that there is a way you can profit by using the bull flag as a trend continuation pattern even on a downtrend? Now this method has to do with the market structure. So if you don't know about the market structure, you can watch it from my price action playlist. It's a rather simple method. You have to look for a few things before you proceed. First of all, the price must close above the downward trend line resistance. Now we are talking about a break in the downtrend structure. Then, if the price forms a bull flag above this trendline resistance, hola, you have got a jackpot trade. What you're doing here is trading between an ending downtrend and a potential starting uptrend. You can benefit tremendously if you are able to catch the uptrend from the beginning itself. Now the entry, stop loss and target conditions will remain the same, but I suggest you use a trailing stop loss such as a 20 period moving average, since we are taking sort of a contrarian position just to be safe. Now a bear flag pattern is just the opposite of a bull flag pattern. It is yet another continuation chart pattern, but the bear flag signals that the market is likely to move lower. So I will be quick with this one, or else the length of the video will be too long. And if you are able to understand everything associated with trading a bull flag, then trading a bear flag is just a walk in the park. You just have to flip everything you learned with the bull flag at 180 degrees and there you have it. You now know bear flag pattern. Now here's how to identify a bear flag. First you have to look for a strong trending move lower. This means the range of the candles is more bearish than usual and they tend to close near the lows. After the strong bearish move lower, the market takes a break in the form of a pullback. Now the pullback should consist of smaller range candles compared to the earlier bearish move, and the more tighter the range, the more likely the market will break out lower. Now the strong bearish move represents the pole of the flag, and the price consolidation during the pullback forms the flag of the pattern. The flag retracement should not move beyond 50% of the pole length, or else it is not considered a bear flag pattern. Now the entry criteria are also similar, except for the fact that we will now be looking for shorting opportunities only, being a bearish continuation pattern. Now you can look to sell when the price breaks below the support trend line, but it is usually prone to fake outs. So the better option is to wait for the breakdown candle to close and then enter below its low. But sometimes if the breakout candle is very large, you will be entering at a very low price and the risk to reward will be affected. So you can either wait for a pullback or retest back to the breakdown trend line and then take a short entry when the prices start to move lower. Now the issue with this entry technique is that during a strong downtrending market, the price won't pull back often enough and you will miss out on most of the opportunities. So it is up to you to decide your entry strategy and continue practicing it over a large number of trades. Also make sure to validate if the breakout is real by using volumes and momentum indicators like MACD, RSI, etc. When it comes to protecting your positions, you can place your stop loss at a level that invalidates your trading setup. So a bear flag pattern becomes invalid if the price breaks above the resistance trend line. With that idea in mind, you have to keep the stop loss above the resistance trend line, or to be even safer, you can give the price some breathing space by keeping 1 ATR buffer above the swing high level, depending upon your risk appetite. Now finally, the target can be based on the price projection method or trailing stop loss method. In case of price projection method, you have to measure the length of the flagpole and then project it from the breakdown point below the support trend line. This will give you your projected future target price. For the trailing stop loss method, you can make use of moving averages like 20 or 50 period moving average depending upon your trading style, or you can use an indicator like Chandler stop to ride your positions in case of a range breakdown or strong downtrend. Now, it is a deadly combination if you make use of both these techniques to exit your winners. Now, the most important thing to figure out is where to find these flag patterns. You can find a bear flag during a support line breakdown, which is followed by a primary pullback. Now, the breakout candles represents the flag, while the primary pullback forms the flag consolidation of the pattern. Now, you can take a short entry as per the entry criteria of your choice when the price breaks below the flag consolidation. Now, the most common place where you will encounter